All right, we're going to get rolling.
They helped create an economy that was completely addicted to cheap money.
You need to buy savings bonds or something. You need to be way, way, way out of this space.
I subscribe to Miss Piggy's rule of money management. Always manage to have more money, you know what I mean?
It wasn't but 2 years ago that everybody was saying China's economy was going to be bigger than that of the United States. It's gone in the exact opposite direction.
So we're going to jump right in.
Welcome to VRIC Media, the most trusted voice in junior mining. I'm your host, Jay Martin, and my guest today is Patrick Karim. Patrick, it's great to have you on, man.
Jay, always an honor to be on your channel. Can't wait to get into it.
Let's do it. There's a handful of directions I want to go today. So here's where we're going to start, though. I'm going to ask you one broad question and then just pull on threads. When you think about the macro picture right now, Patrick, what is striking you as the most significant themes, either something that you're most focused on or that the public is grossly misunderstanding?
Look, it's so weird because when the yield curve was uninverting and the market was having a little bit of hard time, everybody was, we're in a recession, it's happening. But then the market starts ripping upwards, staying above moving averages. But then people say, that yield curve thing, that was nothing. We forget about that. Nobody's talking about that. The unemployment rate going up 25 or 26%. And I have a great chart to show you, Jay, to create some visuals. Coming off a bottom, that's nothing to worry about. The Fed cutting, they're doing that just for no good reason. It's so weird, the sentiment, like short term, and then the cryptos are popping. It's like, it's fine, for traders. You could write the technicals without having to always fear the fear scenario, right? You don't have to live in the doom scenario, but they're still there, those elements, right? So it's called like the weight of evidence. Look at the charts, but when the macro elements, the macro backdrop is kind of, it could be skittish if ever there's some short-term weakness on those ripping stocks or the cryptos and all that. You got to be really, really careful, right? Even the oil chart, goodness, I could show you the oil chart. It's not signaling like crazy inflation. It's more like recessionary, right? Oil is like about to have a technical drop that could be pretty severe. Oil could really drop a lot, and that's a big thing. And the other big thing that people aren't aware of, but I'm really trying to talk about it, is something we call like a capital rotation process, which culminates in a capital rotation event. And essentially, Jay, we've had 4 of these in the past 100 years. It's when the SPX or gold breaks out versus SPX. So there's 2 major asset classes. There's periods where gold is able to break out versus SPX on a ratio chart, which means if that ratio chart is going up, gold is outperforming US stocks. That means more capital is going into gold, silver, the miners to some extent, copper, oil, all that stuff. And I'm really looking at that chart like a hawk right now, and it's getting really close. Gold is really holding its ground versus US equities. And that capital rotation event is seen when recessions occur. Man, I have some crazy visuals I'll show you later, and that I hope it really helps your audience say, okay, that's what he's seeing, that's what he's watching. Because these are macro events that practically all traders haven't seen, unless like the old school guys. The last time we had a capital rotation event was in the 2001 .com bubble. That's like 24 years ago, in favor of gold. The previous one was like in 1970. And the first one I have for my charts is like the Great Depression one. And I think 1929, 1930, we had one of those. So those are pretty big elements that people should not discount.
Let's dig into that capital rotation event a little bit. We've experienced 4 in the last 100 years, most recently in 2001, prior to that, 1970 and 1930. The leading indicator that you may point to say we're getting close to the next one is gold outperforming the SPX for a duration of time. I would love you to get more granular on that for me if you could, and then expand on the concept of a capital rotation process that leads to a capital rotation event, exactly what that is.
All right. Well, I think this is the best time right now to do a little show and tell.
Let's do it.
The best thing I could do probably is build one right in front of your eyes for your viewers. I've done that chart so many times. So XAU USD is gold divided by SPX. So monthly chart, gold versus SPX. I'm going to reset the chart, remove all my indicators, just keep it, and I'll put it even on the line chart for you guys, step line. So that's gold versus SPX. Jay, look at that. Since I'm going to put on the monthly.
This
Look
is
at the
gold
data.
versus
Since
the SPX since 1902.
1980, like 18, sorry. Yeah, 1889, 18, yeah.
So gold price versus US equities for the last 120 years.
That's right.
Yeah.
So let's see here. So here, as this goes down, that means the SPX is destroying gold. Of course, gold was pegged right here. I could have done it with a silver chart, but eventually gold is able to put in a bottom versus SPX. And when that happens and it's able to go upwards, I could have done oil versus SPX. I could have done silver versus SPX. When that goes up, this is what I call a bull era for commodities, for precious metals. I could overlay the gold chart on this. I could overlay the silver chart. I'll put the silver chart for you guys. Whoops, not that. Compare symbol here. Add a symbol. XAGUSD. New price scale. And look at that. This is the silver chart. I'll put always, guys, on log scale. This is the silver chart right here. And look what happens when gold breaks out versus SPX. Silver tracks those capital flows all the way up. And as it unwinds, as gold starts to break down versus SPX, I'm just going to move that over here, starts breaking down. That's the last secular bull era we had for stocks. 2000, here's the first capital rotation event was up here. Where's 1939? My goodness. Down here, up all the way up here. Here's the second one.
Roaring 20s.
Oh, goodness. Yes. But this is the thing. In the gold was pegged back then. They unpegged it eventually halfway through they unpegged it, I think, in the mid 1940s. And then after that, they unpegged it finally in the 1970s. So a ratio chart where one of the two elements is pegged gives you less vital information. But here in the 1970s, it's unequivocal. Here in the 2000s, here's a breakout upwards. Gold breaks out versus SPX, the third capital rotation event. Look how silver tracks that. I could also overlay the miners, Jay. The miners did pretty well here. Uranium, copper, oil. So look what's happening now. Silver is already holding its ground. So silver and gold and silver are already in bull markets in their own right. So their own price chart, higher highs, higher lows for gold. Silver, higher lows, higher highs from this peak here. And as soon as it does higher high from the previous peak, then it's a bona fide uptrend. So they're both in bull markets. A bull era, a capital rotation event is when SPX, once again, when gold is able to break out versus SPX. Here, there's a bottoming pattern. I could even go more granular. I think right here we have a more meaningful level is right about that 0.48 level. If gold is able to go up above this threshold here, we're going to start having a higher high here. It's already doing higher lows versus SPX. Higher high, that's a definition of an uptrend. It's higher lows, higher highs. And the more it could go up, then if ever it's able to do a higher high, higher than here we did in February 2020, that just means we have a more powerful uptrend. I'll show you why this is important. Here, I'll overlay the recessions, Jay. Check this out. Recession indicators. Each of these moments where gold breaks out versus SPX, there's some turmoil. This is the first capital rotation event. Very important here at turmoil. Here we also have here the second turmoil halfway through that bull era for gold. Mm-hmm. Here on the turn, we have another recession. And here we have the GFC recession. So we have two sections here. Even here, that small recession we had back in the March of 2020, yep. Gold was breaking out versus, so that was just testing this bigger breakout line. Look, this is the first piece of evidence that we're probably going to be in a recession as soon as this turns, if we're not one already, because I have to show you another chart. Check this one out. This is the unemployment rate. It's crazy how people aren't looking at that anymore. I'll remove all indicators. I'll remove all drawings. And I'll add the recessions again. Recession indicator. Check this out. Every time the unemployment rate off a bottom goes up 20, 25, 26%. Here, let's say 25%. Recession, like really early recession. Look here, second, another recession, off 25% off a bottom, off 25 in the recession. Success rate, 100%. Here, the 2000 ones. I'm sure your eyes is already going to be here, that 2020. Look how much we've moved already. Mm-hmm. Am I the only one looking at this? A lot of people have looked at this, right? 100% of the time, there's a recession, officially declared recession, once the unemployment rate moves 25, 26% off the bottom. And it's more than that. Look at the recession. It doubles from the unemployment rate. It doubles from there. Nominally, right? Here, it doubles. Mm-hmm. Here, doubles on that second wave. Here, doubles. Sometimes it even triples. Here, doubles. So what I'm seeing here, and the Fed's probably looking at that also, they're seeing the rate of change. They're seeing that unemployment rate, even if it's still low, I know people say, 4%, it's kind of low. Yes, that's fine. But they're reacting to how is it getting to that 4%? It's off a super uber low, moving up. I think we're going to get unemployment rate like above 5 there if this continues upwards. So this in line, remember the recessions I showed you in that previous chart, they also align with gold breaking out versus PX. So now you have the unemployment rate in that capital rotation process. If you see, you could see that as check marks, Jay. Every time I show you a piece of evidence, okay, check. It's like the setup's there. This has not unwound. If ever the unemployment rate starts unwinding and then it breaks down a rising trend line, I say, okay, the risk is off. But right now, when I see that, I say, oh my goodness, there's something. People are still not fully grasping what's around the corner. And I'll show you this NVIDIA chart. NVIDIA, I asked ChatGPT, NVIDIA is 14% of the NASDAQ. That's 14% is where they have a rule where they have to start rebalancing. Like I think Apple was 14% back in late 2021, and then Apple went in a severe correction. I forget how in 2021. NVIDIA right now is 14% of the, I have even a better, look at this, look how stretched it is. At the bottom pane is the distance of the price from the 3-year moving average, guys. So the 3-year moving average is that red line right here. Mm-hmm. So beautiful uptrend. But when you're stretched historically from that 3-year moving average, there's often a reversion to mean that happens. And check it out. This is, once it breaks down, it just went up a little bit and then corrected. It let that moving average catch up. This is healthy stuff. Here again, as soon as it lost that distance 200% above the 3-year moving average, look at that huge correction. And look where it is today. Mm-hmm. This is what I tell people. You don't call tops. You just don't do it, because you've interviewed tons of people, Jay, and you can interview them year after year, and they're always calling for a top, right? And it's like there's a top. It's like that expression, a broken clock is right twice a day. So you don't call tops, but what I could tell you right now is the low risk entry is not there anymore. You could probably guess right now where the low risk entries are. The low risk entries are somewhere where the price is coiled and tight close to the moving average here. Yeah. Right after a correction, and it starts moving back up like here. But it's not like here. Now we're stretched. Can the price go up? Of course. The price could go up. The moving average could catch up slowly. But being that stretched in conjuncture with that unemployment rate chart, with the gold versus SPX chart, with that recession that's right there, look, it's bonkers. I'll show you, okay, if you bear with me, I'll show you the US oil chart. That thing is kind of scary. Here is the oil chart. Technically, I'm more worried about technical levels. For a while, look, I thought this would break to the upside, but it's not breaking to the upside. And look at this critical level. Like, look where we are here. Huge move up, echo bubble. It could have been bullish. If it resolves above here, Jay, it's okay. You know, this is going to resolve upwards. But right now, it's look, I'm holding my breath there. It's lost some rising trend lines. This is not good. If this breaks down, and I'll show you, I'll add again my recession indicator pane. When oil tanks, and the market's probably going to tank, oil's going to be showing signs of possible recessions ahead of time, right? Look, oil was having a hard time way before that COVID panic, right? It was already not doing new highs, already having a hard time, way before the COVID thing. Recession here, oil flares up, but again, recession pulls it down. Recession flares up, but look, a recession brings it down. It's evidence that we could grab from the past, telling us, okay, oil's not flaring up. Oil's actually, if it did its flare up, it's that flare up it did here. Now it's tinkering on the brink of really having a severe collapse. Gold versus SPX, unemployment rate. Goodness, it's like the evidence. It just piles on there.
Quick break here, guys. Today's episode is brought to you by Coppernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Coppernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galliano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and VRIC on his board at Coppernico Metals. Check out coppernicometals.com. Now back to the interview. Okay, so pulling on those, I mean, what do we outline here? We had a look at the unemployment rates and the record of performance in advance of a recession, NASDAQ consolidation right now into one stock at 14%, and that stock's history of bouncing off a 3-year average to the extent that it has today. And typically what happens next is a massive pullback. If a massive pullback were to happen today, having consolidated 14% of the NASDAQ, it's a big move. It's quite a devastating move. What's the consequence, Patrick? So, we have corrections in the market on a regular basis. Some are significant, some aren't. We have recessions on a regular basis. Some are significant, some aren't. Step back a little bit and talk about the significance of our current macro setup with the cues that you just outlined for us.
You're right. Recessions that happen. If you have a recession, it all depends when the recession happens. If you have a recession in a secular bull market for U.S. equities, so remember that 1970s to 1980, gold was outperforming SPX. That was a bull era for precious metals. That was a bear era for SPX. So if it's getting a recession in the early 1980s, it's not going to impact it that much. It's still not that stretched from its moving averages. It's a baby bull era. So that recession gets digested and, there's no problem. It's like that old thing there. Bearish news in the bull market is bullish, and bullish news in a bear market is bearish, because it's those macro capital flows as defined by gold versus SPX, which really carves out these charts. Because remember, the gold versus SPX chart, I overlaid the silver chart. I could overlay all these commodities, different supply and demand mechanics, different. Even I could have put the miners in there, different CEOs, like it's a whole bunch of different stuff. But their charts look pretty much, from a high level, they look like that. So now the next recession, if gold does not break out versus SPX and there's a recession, it could just be a blip, just a blip in that secular bull era for SPX. It's just going to be a correction, and it won't be severe. I'll tell you one thing I didn't mention to you. That gold versus SPX ratio breaking out, having this fourth ever capital rotation event, it happens, and this is hard for people sometimes to understand, it happens with gold going down, but SPX going down more. So guys, if I have a ratio chart and have gold going down, but SPX going down more, that ratio chart is going to shoot upwards. And that's what we see on these capital rotation events, right? That's when people say, a U.S. equities crash or the start of a bear market is going to drag down gold. Yes, because that's what the chart shows us. They're going to drag, and gold also super stretched from its moving average. That's why, it's entering right now. I could show you. I'll show you a chart I did on X there. Window. I'll share this one here. I pinned it. Gold also is stretched, Jay. Look at this here. It's stretched from its moving average. That same exercise I did for NVIDIA, like I'm objective and unbiased. It's bull market for gold, but it is 100% stretched. You see every time like it's been stretched, it has chances of pullbacks. It could not pull back or have a more moderate pullback 4 or 5 months. It doesn't have to be some crazy pullback to 2350, but it is in a period where it's stretched.
Walk me through the reset in sentiment required to hit $4,000 gold.
Yes. Well, see here from a TA perspective, there's huge bases and then there's an explosion out. Once you got that move, it sets up the next measured move target. So here it explodes up. Here there's practically no FOMO. When the price is, when the price is quelled close to moving average, what does that tell us? It tells us the price has gone nowhere for a long time. People they don't see the performance in their portfolio. Nobody's talking about it on the news. People are giving up. That's a dead asset, right? Mm-hmm. But that's always a setup for the next powerful move. Now you get these crazy moves up. The price distances itself from the moving average. That's when everybody gets in, right? How bullish was it back in 2020, right? When gold was all the way back close to 2000. It was, I can't say unbearable. Like it was fun. It was the good times, like everybody was going, throwing the champagne out. But if you look at the charts, you could have said, oh my goodness, I'm stretched. Does it have to pull back? It doesn't have to. Sometimes, it could have just kept grinding higher and letting the moving average catch up, but it went sideways now, letting that moving average catch up and also reset the sentiment. All of this is a reset in sentiment here. It's like it goes sideways, people give up, remember, and once that consolidation is over, look at that exact measured move, bam, explode out of it once again. And it repeats. Stretch from the moving average. Everybody, like gold right now, 2,700, 2,800, right? Now people are super happy. Like I see it in the Twitter because on X, I did a chart, Jay. I could do bullish charts when we're at peak FOMO and people go crazy. 500 likes, 1,000 likes. It's crazy. I see it, right? So now we're stretched. As soon, I'm going to have to refresh this because this is a monthly close basis chart. As soon as the distance from moving average closes below this rising trend line, you could say that now we're in a correction, that we're losing momentum. We're not able to distance ourselves away from that moving average as fast as we can because the low risk entries are when the capital flow is going so heavy into it that you're able to outpace a rising moving average. That's powerful. You want to ride that. But you don't want to hold on when you're not able to distance yourself from the moving average as fast as you could before. So right now, I'm just expecting some type of consolidation for 5, 6 months, maybe longer. I don't know. I'm just waiting for some. And when it breaks out, hopefully that 3-year moving average will be so tight and coiled that then that will be the reset in sentiment. And guess what? My next measured move will probably be a similar type of move from an $800 move, $900 move, all the way up, or it's even more probably. It's 2,700. That's 1,300 move all the way to 4,000. So I want to see those reset in sentiments, and because they're the best launching pads to really get a new low risk, high probability, high reward entry right there. It's just not now. Look, 2,700, 2,800 gold, even it's like, if you're a stacker, guys, who cares about the price? You're stacking ounces. You're just piling on ounces. You know your ounce is going to buy you pretty much what it did 10 years ago, 20. Yeah. Like over long periods of time, I have charts like showing that it doesn't quite matter for stackers. But for a trader, on this time frame, gold bull market, yes. Low risk entry, no.
Yeah. Okay. Got it. Would you apply similar rules to your thesis on silver?
Exactly the same. So silver, it's kind of I'll have to show you again the chart there. So silver, it's not as stretched from. So okay, that's the silver chart I was working on. I'll just do here. Remove all drawings. Silver, same thing. So here I have distance from moving average, my bottom pane, and it's not that stretched silver from the moving average as it could. Here's in 2020, it did a peak. Here are a few peaks during the next bullet. So there's still room for silver to distance itself from the moving average. And until it closes below this rising trend line on the momentum, you could say it's fine. You gotta, there's still some room here. I call this fuel in the gas tank, right? As long as it's able to go here, this is resistance, right? This is like so as long as it's able to do that, it's fine. What I don't like as much is because gold is stretched, it's very rare that you see silver go bonkers when gold is not also on accelerator. It happens sometimes where gold stalls and silver is able to outperform. So, and the gold to silver ratio drops, but it's not optimal. So you got to be really wary. Sometimes, you got these further away resistance lines, but sometimes if you're less greedy, you go down. This is what I call the wall, Jay. It's after a melt up, then it tests support. And once you break below it, it becomes resistance. And we could be at that area. So if somebody's already in silver, it's fine. You could sell into strength here, but if you want to wait and give it a little bit more leeway, you could always wait until there's more weakness. So once it starts closing below the 12-month moving average, the 36-month moving average. But yeah, gold's a leader. Really, I'd like to see gold resolve its current possible important correction. And once gold opens the pathway, then silver is just going to go
right.
Just going to have fun there.
Can you walk me through your portfolio at all, Patrick? Like where are you currently and how are you positioned?
Well,
as high level or as deep as you want to go?
Right now, look, the DXY, I did show you the DXY chart, but DXY, and like you're Canadian also there. It's like, I have a lot in, of course, guys, not financial advisor. I'm holding as many US dollars as I can right now because it's about to break out with the USD CAD is about to break to the upside. The DXY also, USD CAD tracks the DXY. It's part of it. The Euro USD, it tracks it. The DXY is about to break upwards. Like we had Brent Johnson on recently talking about the milkshake. But technically, I have to show you. I don't know why I stopped sharing the screen. I should just keep it on because you guys got to look at the DXY there. Check this out. I just posted this on Twitter not too long ago. Right here, the US dollar did this. Are you seeing my screen, Jay?
Yeah.
So this is the weekly chart. The US dollar. It's a coiling triangle, so the market's trying to find for a decision. It did here a breakdown. So it's a rising trend line. Guys, breakdowns are not all equal. Horizontal line breakdowns are the most important, or horizontal line breakouts, because if you get a close above a horizontal breakout line, it tells you that you have a higher high, so that's an uptrend. But it did a false breakdown here, and then it shot upwards, refusing to do a further decline through the apex on the other side. That's uber bullish. It's called a false breakdown, reverse move. It catches everybody off guard right here. That's probably when silver was really overheating, and it's just rocketing upwards. It's like even the USD CAD. Look at this thing, man. It's like that thing's close to breaking out. It's like from a huge pattern. Look at this thing here. Goodness, look at that. We could have the fundamental bearishness about the US dollar as much as we want. But that thing here, if that thing breaks out here, there's even shorter term. Goodness gracious! Look at that thing. That's higher lows. If it closes above here, it's higher high. So we're looking at it's pretty impressive targets there. Goodness, 154 targets there for the USD CAD, which would bring us, guess what, to almost what we had at the .com bubble. Imagine having that, right? 155 once again. So the US dollar is a position. It's fine being there. We have there's some crypto plays there that we have also right now. If you're a trader there, you had some great opportunities. Bitcoin's running a little hot there, but I think it was like 1 week ago there. I can't remember. We had for our members there. We talked to them about the Solana trade. Mm-hmm. But it's all technical. Like the capital flows are going into the cryptos right now and Bitcoin, and they're outperforming practically everything. But other than that, it's other than for stackers, long-term investments, those are the positions that we're holding. And until that gold versus SPX chart breaks out, And because like the SPX, like you see the NVIDIA chart is so stretched, it's not a time to be, pedal to the metal, And some people say, oh, you missed out on the final top. Well, I don't mind like missing out on that, because for me, whatever happens in the future, it doesn't override what did I respect my trading framework. Was the weight of evidence really telling me that we had a low risk, high probability, high reward entry at this point? If the answer is no, even if it does melt up and goes up 50%, I don't care, because it's always people in hindsight, right? People like, averaging down or calling bottoms. It's like only in hindsight, you're going to know that that was a bottom, right? So NAV preservation is key for a trader, because you know that, like, let's say you go down 5%, you just need 5.5% to break even, right? And the more you go down, if you go down, I don't know, 33%, how much you need? You need 45, almost 50% to break even. Mm-hmm. And if you go down 50%, what do you need? You need 100% to break even. Mm-hmm. So NAV preservation, number one. The US dollar is a position. It's about to break out versus the Kenyan dollars. It's fine. And if ever it starts faltering, the DXY, then just close that trade and you go into whatever currency is outperforming. But goodness, man, it's like.
So you're very patient right now. Like you're effectively, I mean, I don't want to call it sitting on the sidelines, because I agree with you. US dollar is a trade, but that's your basket right now. And outside of that, you don't see any asymmetric bets. You see some setups occurring, but nothing actually that's positioned right just yet. Is that correct?
Well, uranium possibly. It's so weird. There's some uranium plays out there that are looking not bad, like Cameco starting to resume its uptrend. There's even some oil. Even if I showed that oil chart that's about to break down, there's conflicting information, because then you have the XLE sector. It looks like it's about to break out. Suncor is about to break out. It's like, it's kind of weird. Sometimes when I don't have the full weight of evidence, do I trust that breakout? It's like, it's not time. You feel it. It's so weird. How can I tell you? Like there was I forget, over a year ago, the uranium sector had just finished its 2-year consolidation or 1.5-year consolidation, and everything was breaking out. There was the unemployment rate was still dropping or barely moving off the bottom. It was okay. It's good. Let's lever up. Let's press the the lemon at that stage, at that moment. But right now, it's just, it doesn't feel like. I know people have the itch. They always want to be fully invested, but we're rather defensive. And then after that, once we get those meaningful breakouts, even like JDX and all that, the miners, they hit important breakout lines. That crazy move they did off the bottom, for me, that was just a setup. I could show you I'm sure your viewers will appreciate me looking at the miners chart. Let's put the ASA chart. The ASA chart for me is it's the JDX essentially, but you have data going back all the way to the 1960s, right? I could overlay on this JDX just for people so they could see that this is actually the same thing. Mm-hmm. New price scale, logarithmic. Here, see, that's practical. It's the JDX, right? That's why I say capital flows drive this stuff. The ASA has different miners than the JDX, but essentially what drives one drives the other. So if you want more data, guys, and you say, the JDX, how did it behave in the 1970s? Well, you don't have to guess, because just use the ASA chart. So this is the move that it did. This is a setup. Look at this. Look at this. Look at the reaction on this. 1, 2, 3. This is a valid trend line right now, Jay. So this is a trend line that goes back over 14 years, bigger the base, higher in space. This is crazy. This is the move that everybody wants to play, right? So this warm-up act, whatever happened here for me, that was just a warm-up act. All this move off the bottom here. And right now it's probably stretched. I'm going to put up my distance from moving average. Let's see how stretched it is. Yeah, maybe hitting that wall, not get too greedy. So the miners, oh goodness, it's possible that they're about to lose some rising momentum here. So entering a correction. The true mind-boggling gains for me is not this here, this lower here. It's entering here and then riding all the way up. So that's a huge, huge pattern to play. And we're on the cusp. And look at these huge patterns. Guess when we had it the last time, Jay? We had it at the capital rotation event. It's like Remember the 2000 turn?
Yep. Yeah.
That's, I know people, they love averaging down. Look, I don't want to go in too much. I could debate about it, but it doesn't make sense for me. If you're patient, you play it here and you ride that thing here. Or you could even, you could have probably here, it moves so fast there. There was probably an opportunity to play it here. But right now, this is the play of the lifetime for the miners there. If they had a chance, look, the miners are perennial underperformers. Price and gold are terrible. Maybe adjusted for dividends, they're able to hold their ground a little bit. But price and gold, the miners are just terrible. But they love when there's a recession. They love when there's a capital rotation event. They love when the unemployment rate goes up. And it's happening now. So if the miners had a chance, it's that descending trend line I drew you. If ever we get a solid monthly close after that, hopefully we consolidate a few months there to let that moving average catch up.
Yep.
Goodness, man, your channel is going to blow up 5x there. It's going to be crazy there. Everybody's going to have gold miners, but once we're above that line there.
Okay. Got it. Look, Patrick, what can people find it at North Star Bad Charts for somebody who's not familiar with your platform, what you built, what you do? Walk me through that.
All right. Well, guys, look, Kevin and my partner, Kevin Wadsworth, North Star Charts on Twitter there. We posted a whole bunch of stuff on Twitter, but eventually if you want in-depth detail, you can't nuance stuff on Twitter. Sometimes I put a chart there and it's not the good place. So we built a website called northstarbadcharts.com. And like everything I talk to you, like the weight of evidence, even our track plays, our trades, like all that stuff, the risk reward profiles, we dump it there. We have a knowledge base. We have a learning center for people who want to ramp up. Some people, they don't even want to ramp up. They just want, tell me what's up, Mm-hmm. There's that also. But if somebody who's curious, who wants to understand why they're taking decisions, and they should, I think everybody should, you shouldn't go play poker and not understand the rules or get wiped out. It's so funny for me that people, they go in the stock market, they drop 10K, 100K without even blinking an eye because they heard a guy on Twitter say it's going to do a 10X, and they take the nickel and dime their wife for their new fridge because it's not that the research doesn't correspond. It's crazy, the mindset people have in the stock market. They go, they see blurry. They just go crazy there. So yeah, that's what we offer, like down to earth, well thought out research analysis.
Okay. Yeah. Thank you, Patrick. Look, it's been great having you on the show today. And thanks for sharing so many visuals with me. I appreciate your time and love to have you back.
Anytime you want, Jay.